Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at the Walt Disney Company, ticker DIS. This one, it's not looking the best. I think it's a little overvalued. Fundamentally, nothing really looks great. With honestly a pretty generous thesis, still underperforming the market. I don't even know what kind of portfolio it fits in. Dividend is really low. Payout ratio is not good, so it's not a dividend stock. It's not a growth stock with revenue growth of only 4.5% and underperforming the S&P. It's just kind of a really large blue chip stock that's trying to stay relevant. Had some down years, kind of on a recovery. If they can continue this recovery, we'll see how things play out. But as it stands now, it's not looking too good for them. So I'm coming up with a fair value about $98. And actually right now it's around $120. With a discounted cash flow of $61, because our cash flows are pretty low. And I mean, you can see they were low in 21, dipped down in 22, recovered in 23, had some nice growth in 24, and we'll see how it plays out going forward. These are based off of what we put in for our thesis here, which at the moment is 8%, nearly double the revenues to try and get them up above a 10% yield in the next 5 years. Dividend, 0.91. On average, 0.32. They only started this in 2023, at least for this 5-year time frame. They didn't pay it out in 2021 or 2022. And they grew it quite a bit recently. So we'll see how things play out in the future. The lowest that I'd really want to see from them is 10% growth. 15 wouldn't be too bad either. And that's why I have that in the thesis. Payout ratio, still a little low. They got room to grow it. So we'll see if they're able to do that. ROE, 4.92%, pretty low. ROI, even lower, 1.5, and ROA, 2.5. Like I said, returns are super low with it. With the debt that they have on their balance sheet, they're just destroying value at the moment. Balance sheet honestly doesn't look too bad, though. It could be a lot worse. 0.9, we do like to see that south of 1. So that is one green flag here. Gross margins, 35.8%, on average 34.1. So those are up. They're in the realm that we like to see, but the nets are just pretty low. 3.7 on average, 5.4 for last year. Would really like to see that get up above 10%. That's everything for the fundamentals. So one good thing, debt to equity. Bad things, dividend, returns, average cash flows, net margins, price to earnings growth. It's not pretty. It's definitely a recovering company, but it still might be early days in that recovery for us to really glean anything into how things are going and will go in the future. Revenues over the last 3 years looked pretty good, 10.7%, but in the last 2, it slowed down a bit to 5.13, and analysts are projecting 4.1 this year and 4.8 over the next 2 years. So 4.5 is probably fair for our thesis for revenue. Share count, I want to give them the benefit of the doubt. That's what they really need to do, is buy back shares. Over the last 3 years, they did buy back some, but in the last 2, they issued some. So I'd like to see them get back to the minus 0.2%. But like I said, that's probably a little generous. We haven't really seen that out of them. Maybe 0.1 would be a bit more realistic if they were to start buying back shares. Cash flows I had at 8%, and we could raise it up. I mean, 9% would be twice what you're getting for revenues. So you're bringing the cash flow yield up to 11.6, which means we're kind of building a best case scenario here, honestly. Assets pretty consistent. They have been selling off. They've been selling off somewhere between 1.3 and 2%. So 1.5, it definitely seems like it's fair for the thesis. Liabilities, they've been paying down 3.5 over the last 3 years, just shy of 2.5 over the last 2. So 3 definitely seems fair there. They might be slowing down a little bit with that. So, 2 would also be one worth testing out. Dividend, we'd like to see them come in with some pretty big growth after instating it in 2023. And if they're able to come in at this 15% growth rate, we're looking at 1.8% for our yield on cost of buying at today's price in 5 years, with an annual dividend of $2.20. And then margins, I'd like to see them get these up quicker, actually. So let's say they're able to get this up. 3% growth brings them to 6.3. Let's try 5, almost 7. 9 brings them to 8 in the next 5 years. Again, we're being really generous. 12% margin growth brings them to 9.6% in the next 5 years, and even that's just not enough for them. You're looking at a fair value in 3 years of $117 and in 5 years of $132 based on this thesis, which means that you're underperforming the S&P by 25% over the next 3 years and 30% over the next 5. Because with the dividend and everything else, we were being generous. You're only looking at 7.4% returns, and S&P, we estimate somewhere between 8 and 10. So even best case scenario, you're underperforming the market. Once you get this big, it's hard to continue growing. You can cut costs. That's one of the biggest things you can do. Get those margins up, cash flows. And they definitely need to do some of that. But what they really need to do is regain relevancy if they want to stick around. So we can take a quick look at pricing and see where everything's at. They were really struggling in 2021, 2022. Everything was low, but the share price was high. And the share price came down while everything started coming up. So share price bottomed out here in 2023 at $92 on average, with the balance sheet way up above at $185 and everything ranging around between $8.5 and $53. So cash flows were the closest to the actual share price. Cash flows and fair value were right there. So in 2023, it was worth about $50, was trading for 92. And then in 2024, so this last year, it recovered a little bit. Average price of 102. Fair value grew 50% from where it was up to 77.5. Everything really saw some growth aside from the balance sheet, which pulled back a bit. And then we stand here in 2025, and you can just see how tightly clustered everything is. This thing is obviously worth right around $100 based on just about every metric. The dividend is way down there. It's because they only instated it in 2023 and are doing some growth. So this is based off what the market typically likes to spend for that dividend. The calculating that based off the yield and the price in that year. While the balance sheet is way up ahead, still on the decline, but not too quick. And that's part of why their return on equity and assets and investments are so bad, is because they have so much, but it's not returning a whole lot. And that's why they're selling it off. They're doing some of the right stuff. You can see they've had a really good recovery since 2023, have always traded at a bit of a premium. If you look at this, 2023, so they were trading for $42 premium, trading for a $25 premium in 2024, and at the moment they're trading for about a $20 premium. So that's the lowest premium we've had lately. If the price goes down and the fundamentals go up, it could become a value play, but while underperforming the S&P, I would steer clear of. And that's all I have for this one. If you got in 2023, you might be looking okay. If you got in before that, I'm sorry for you. If you want to stick around, it might be a while for it to come back up to the price that you got in at. And even if you're getting into this for a turnaround, you might be a little late, 2 years into the game, and still, you'd expect some better growth here than underperforming the S&P. But I want to thank you guys for watching. Please like, share the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.